Alright, in my last video, I showed you how I lost about 130k by waiting too long to invest. But here is the most important part. If I could go back in time, like back to 18-year-old, what would I actually buy? What would my portfolio will look like if my goal is simple, grow wealth for decades without overthinking it? Today, I'm going to show you the exact 3 ETF portfolio I would start with and stick with for the long run. And don't worry, I'll keep this a beginner simple and we will do the allocation together. Here is the real reason why people don't build wealth, because they keep restarting their portfolios. 1 year is tech stocks, next year it's dividends, then it's covered calls. Every time you switch strategies, you reset your compounding clock. And it doesn't feel risky, it feels smart. This is what most beginners don't realize. Compounding only works when you stay consistent. That's why before we talk about returns, before we talk about income, we need a structure that it does not change every year. And that's where 3 bucket frameworks comes in. So instead of constantly changing strategies, I think about investing in 3 buckets. No 12 ETFs, not 8 themes, just 3 ETFs. Every long-term portfolio already has these, whether people realize it or not. Think of it like building a house. Core is your foundation, growth is your expansion, and defensive is the shock absorber. Some people overweight growth, some people prefer more stability, but these 3 components rarely disappear. And when you understand the role of each bucket, you stop chasing trends and you start building structure. Now let's break down what each bucket actually does. A quick disclaimer, this content is for education purpose only and does not constitute to financial advice. Please always do your own research. Bucket number 1 is a core. This is the engine of your portfolio. This bucket owns the entire market, not just one sector, not just one trend, the entire market. If the market grows over the decade, this grows. If the economy expands, this expands. This is where the long-term compounding lives. Now here are some of the examples for the core ETFs though. If you are in Canada, VFV, XEQT, VEQT, XUU, ZSP. And if you are in the US, VOO, VTI or SPY. Different tickers, same role. The goal is not about picking a perfect ETF. It's about owning the market consistently. Bucket number 2 is a growth. This is where you add acceleration to your portfolio. This bucket usually includes companies reinvesting profit to grow faster, tech-heavy exposure, higher volatility, bigger upside, and bigger drawdown. This is typically where Nasdaq style exposure lives. But here's the trade-off, guys. When the market drops, this bucket drops harder. Higher wide requires higher tolerance for volatility. And here are some of the examples for growth ETFs. In Canada, QQC, HXQ, and TEC. In the United States, we have QQQ, VUG, SCHG, different tickers, same growth role. Powerful, but only if we can emotionally handle it. Bucket number 3 is defensive. This is the part that keeps you calm during the market crash. This bucket usually includes stable and dividend-paying companies. Lower volatility, slower growth, but it helps reduce panic. It probably won't outperform during those big bull markets. But during downfalls, it often falls less. And that smaller drop is what keeps you invested. And here are some defensive ETF examples. In Canada, we have VDY, XDIV, ZDV. And in the United States, we have SCHD, VYM, and DGRO. Again guys, different tickers, same defensive role. When you combine core, growth, and defensive, you stop chasing trends and you start building balance. Now, the big question is how you actually divide this. But here's the catch, guys. There's a not one perfect answer. Now, guys, let's start with some of the example. The first one is balance. In the balance, you can do the 40% core, 30% growth, and 30% defensive. If you are comfortable with volatility, you might tilt more towards growth, 40-40-20. And if stability matters more, you increase defensive, 40-20-40. The goal is not optimizing this every year. It's choosing a structure and staying consistent. And guys, the real magic doesn't happen overnight. It doesn't happen in 1 year. It happens if you stay invested for 10, 15 or 20 years. And when you combine structure with time, compounding starts doing the heavy lifting. So, if I can go back to 18-year-old, this is the exactly structure I built. Core, growth, and defensive. It's not about finding the next hot ETF. It's about building something you don't have to keep fixing. If this helped simplify investing for you, subscribe. Because next, I'm going to show you how to turn this into real dollar plan. And remember guys, consistency beats perfection. Alright guys, I'll see you in the next video. Take care for now.